Joining us this morning, it was WisdomTree's Global Chief Investment Officer, Jeremy Schwartz. Jeremy, good to see you. Thanks for the time today.
Great to be with you, Carl.
Watching core come in a tenth hot and then watching yields go lower might suggest to some that the bond market is worried about the Fed being late.
We are definitely worried the Fed is going to be too slow. They were too slow during the hiking cycle. We're worried they're going to be too slow in this cycle. You know, we have our own measure of inflation that puts in real-time housing data. We see what inflation is today. It's a singular issue, really, of housing. You put in real-time data, and we have half the inflation, 1.2 headline, 1.5 core. The Fed should not be slow in getting to neutral. We'd like them to get to 4% below quickly.
So then why is there this rhetorical argument that somehow 50 basis points is out of reach?
People, it's funny that they say this is going to be a sign of panic. It's like if the Fed actually showed, like, what are the signs, what are the evidences that would be a sign of panic? It's just this is a status quo bias of the Fed. You say, well, what's the last time they actually did this? You go back to early 2000, and you really haven't seen a lot of examples of them actually making these more dramatic cuts. We do think that they should be going down quicker, and it would just be reflecting the current reality that they're at their employment mandate, inflation's going in the right direction, and they got to reflect reality versus a slow and deliberate process.
I don't know. We're also right before an election, and I'm not saying that that factors into their thinking at all, but why would they go double, set themselves up for more criticism when the data isn't screaming for a double and sort of urgent cut, both the CPI data today and the jobs data on Friday?
Well, it goes to what is the model that they're following. If you look at the real views of how should the Fed set policy, why should they be so restrictive today? They're at their employment mandate, inflation's going in the right direction. They run the risk, versus their own data, which says that they should be basically unemployment's getting to their target, inflation's on the right way. They should be at neutral, not so restrictive. So yes, there's the political noise, but the reality of the data says that they could be at neutral and they should be at neutral.
Don't you think there's a little second guessing on inflation? Yes, all the signs point to the fact that they're moving to target, but they've been wrong on inflation before, and they underestimated it. And there are still pockets of inflation in this economy, like we saw in today's CPI report, that are problematic.
But it's the singular point of shelter. And the shelter is such a crazy number. When you put in a more real-time number, you have 1.2% headline inflation. Where's the problem? Where's the problem? So, it's just that one singular point. The commodity stuff, the sentence stuff is going down. Our view is that's trending in the right direction. And they definitely risk being too high for too long.
Yeah, looking at the charts that you published, looking at some of these alternative shelter metric charts. Finally, we mentioned crude a couple of times, but I wonder how certain that is as a dynamic that would prevent CPI from rearing its ugly head again.
Well, that's one of those other things. That's very sensitive. Commodity prices have been trending down, so that's positive for the inflation dynamics. If there was a real spike in that, you'd say that's be more worrying, but that's not what the current trend shows. It's been actually heading in a cooler trend. That's also positive for all these inflation dynamics.
So what if they don't do it? Jeremy, is the market going to throw a fit? I mean, we're seeing something like that today. We're down 600. I'm not sure if that's what this is about, but if they don't follow your advice, what happens?
When you put probabilities of the slowdown, probabilities of recession, it's hard to give you an exact number. We're just saying they're running extra risk, that they don't need to take that extra risk. Cutting would lower the probability of the slowdown and recession, and that's where we think they should be.
We'll see what we get out of retail sales as well. That's come to the rescue before on these short-term growth scares. Jeremy, thanks. Good to see you.
Thanks, Sarah.